Good morning, everyone, and thank you for joining me. What we'll cover in today's session is ETFs. So today's session is aimed to be the basics of ETFs. So it's an introduction of all the basic concepts and how these instruments operate. Please give us feedback afterwards. If you're interested in having a more in-depth and detailed session, we can definitely follow that up. So what I will cover in today's presentation is we'll cover what is an ETF. So I will explain what the instrument is and how these instruments came about. I will also talk about the benefits of using ETFs. I will touch on the differences between ETFs and unit trusts. I will then show you what the Sygnia Itrix ETF offering looks like at the moment. We'll look at the S&P 500 ETF as a case study. And lastly, I'll show you how you can access these ETFs. At the end of this presentation, I will take a few questions, but if we don't get to answering your questions, we will definitely communicate with you in writing via email afterwards. So please do send us your questions throughout the presentations, and I will try to address a few of them in the end. Okay, so let's start off with what an ETF is. So an ETF stands for an exchange traded fund, and essentially it's just a unit trust that trades on the stock exchange. ETFs are governed by the same Collective Investment Scheme Controls Act as unit trusts. So essentially it's one instrument, you're purchasing the ETF, but the ETF itself is composed of a basket of securities. So these securities could be, or these assets could be shares, they could be bonds, they could be money market instruments, or it could be a single commodity like gold or platinum. Your ETF will perform well if this basket of goods performs well. And then the reverse is also true. So how did these instruments come about? So passive investing in the developed world became popular in the mid-70s. In fact, by the mid-80s, it became quite the phenomenon. In those days, passive investing was done via mutual funds, but these funds were often very complex, they were expensive, they were illiquid. So that then prompted the industry to develop another instrument, something that's more easily accessible. And then the ETF was born. So the first ETF was traded back in 1990, so 30 years ago, and it was traded on the Toronto Stock Exchange. Not long after, the first S&P 500 ETF was traded in the United States, and that was in 1993. So now in 2020, we find ourselves 30 years later since the first ETF was traded, and 20 years since ETFs have been around in South Africa. So these instruments have been around for quite a while, and they've grown in popularity. Just over the last decade, the assets under management of ETFs has quadrupled. So this is a slide that I got from one of the largest global ETF providers, and you'll see that it starts back in 1993 when the first US ETF was traded. And you can see how both the number of ETFs, so the number of instruments that track various different indices, as well as the assets under management, has really grown exponentially over the years. And if you speak to a lot of experts in this field, they'll tell you that this growth is set to continue in both the number of various instruments as well as assets under management. So before I get into some of the specific ETFs that I want to discuss, there's one important concept that I want you to understand, and that is the creation and redemption mechanism of ETFs. So firstly, where buyers and sellers are able to trade with each other, That is called the secondary market. So if you're wanting to buy a stock on the stock exchange, your brokerage will match you with a willing seller, and that is what we call the secondary market. But us as the ETF provider, so if we look at Sygnia as the ETF provider, we work very closely with an entity called the market maker. In our instance, the market maker is a big company, a big global company called Jane Street. And I will give you some more details a bit later on how we work with Jane Street. So it's important because this ETF market maker, Jane Street, is between yourselves and ourselves as the ETF provider. And this institution makes sure that the markets are deep, that the spreads are tight, and they always make sure that they're there to be able to take the other side of the trade. Okay, so I showed you that ETFs have really grown in popularity over the last 30 years. So why are these instruments so popular? Well, first and foremost, we know that there has been a lot of pressure on the investment management industry to reduce costs. We know that costs destroy investment value over the long term. So ETFs are very popular because there's many good ETFs out there that come at very low fees. And you will see the fees of the one specific ETF that I will focus on today as a case study. And compared to a lot of actively managed funds out there, it's a great way to access the market. And of course, you know, when you pay low fees, the benefit, especially with compounding over the long term, really is massive. Then these instruments are also really popular because of access. So they're easily accessible. If you have a brokerage account with your bank, for example, or any stockbroking account, you can simply find the ETFs listed on the JST, and you can trade them through your stockbroking account. They're also very easily accessible via platforms. So our own Alchemy platform, you can easily register and be able to invest into ETF via these platforms. A huge benefit of investing in ETFs that track global indices is that you're able to access these global markets without having to worry about exchange control. There are a few other benefits that I'll just mention. So from a tax point of view, ETFs are very efficient. You don't pay security transfer tax on purchasing these. From a diversification perspective, as I mentioned to you when we spoke about the definition of ETFs, I mean, you are buying one instrument, but this one instrument tracks a certain index. And of course, that index is made up of many stocks or bonds or money market instruments. So by purchasing one ETF, you gain exposure to a full index, and you can gain diversification benefits. From a transparency perspective, you know exactly what you're buying. So if you're buying an index that tracks the Swiss 40, then you know that those 40 stocks will be exactly what's in your portfolio. And then from a cash flow distribution perspective, if you are holding an ETF that tracks a certain index and the stocks in that index pay dividends, then you as the ETF investor are entitled to those dividends as well. So there's many benefits of this instrument, and it's no surprise that they have gained so much in popularity. So this is a slide. If you've attended a lot of our other webinars or presentations, you would have seen the slide that we use quite often. We're very passionate about low fees in the industry because, as I mentioned, they really do destroy investment value. So this slide is information that we received from National Treasury, and it just shows you that, especially over the long term, that compounding effect of having a higher fee really does matter in the end. And just for us, one of the most important points in ETF investing. So I mentioned to you a little bit earlier on that ETFs are also governed by the Collective Investment Schemes Control Act. So how different are ETFs from unit trusts? Well, essentially, there's a lot of similarities. Both of these instruments pool investors' money. They're both, as I mentioned, regulated by the Collective Investment Schemes Control Act. The one big difference is that ETFs are listed on stock exchanges, and you're able to trade them throughout the day or when the market is open, and you'll be able to trade them as various prices. So the price of the ETF will move throughout the day. A unit trust, on the other hand, is only priced once a day at 3 p.m. And the unit trust is also not traded on an exchange. So as a summary, you could say that an ETF combines the diversified portfolio nature of a unit trust with the tradability feature of any other stock on the exchange, and it allows it to be bought and sold anytime that the market is open. So Sygnia is the biggest provider of global ETFs in South Africa. We do have large assets under management. At the moment, we're offering 10 products, and we have a 13-year history in this space. So what you'll note is that 8 out of the 10 products that we offer track global indices, and 2 of them track local indices. So on the local side, we offer the Swiss 40 ETF and the top 40 ETF. On the global side, we have a wide offering, and I'll quickly take you through all of them and what they track. So the first one that I have listed here is the Fourth Industrial Revolution Global Equity ETF. If you invested in this ETF, the ETF tracks the Kensho New Economies Composite, and essentially you'll be investing in companies that are propelling the Fourth Industrial Revolution. It's stocks that are involved in new technologies, in robotics, in 3D printing. So this is a very exciting topic, and we will actually have a follow-up webinar where this will be discussed in a lot more detail. The Euro Stoxx 50 is 50 blue chip stocks in the Eurozone, also the largest and most liquid. The FTSE 100 is the 100 largest and most liquid stocks listed on the London Stock Exchange. The Global Property ETF will give you exposure to the 40 largest global property companies around the globe. The MSCI Japan tracks the MSCI Japan index, so essentially you'll be gaining exposure to the Japanese economy. The MSCI US is an index that tracks large and mid-cap stocks in the United States. There's just over 600 constituents there. The MSCI World Index is an index that is comprised of 23 developed nations and over 1,600 stocks. And then the S&P 500 ETF is the one that I will spend a little bit of time on as almost a case study that we can unpack. So before I get into the S&P 500 case study, if you have looked around on the availability of ETFs, what you'll notice is that they may be the same index that's being tracked by various providers. So if, for example, you were interested in tracking the Swiss 40 in South Africa, you would do your research and you'll find that there's Sygnia, but also maybe a few other companies in South Africa that offer this ETF. So then how do you choose between, two different providers' ETFs? Well, cost is important. So looking at the total expense ratio is important. I've already touched on the fact that over the long term, higher fees really do destroy your capital. So cost is important, comparing the total expense ratios. Then the tracking efficiency is very important. If the index is, or the ETF is meant to track a certain index, then it needs to do so efficiently. But the two other items that are often maybe misunderstood or ignored is market depth and spreads. So market depth is the market's ability to be able to sustain relatively large market orders without actually impacting the price of this ETF. So here is where we work really closely with our market maker, Jane Street, who I mentioned earlier, is a very large global company that does the market making for us. And Jane Street, just to give you an indication of how big they are in the global space, they trade over $21 billion in instruments every single day. So they have trading desks all around the globe in various markets, and they're able to trade not only around the globe but also around the clock, because they have these offices in various time zones around the globe. And then the spreads is important. So every time you're buying a security, and the same for an ETF, if you log onto your trading platform or your stockbroking account, you'll see that there's a bid price and an ask price. The tighter that spread, it's indicative of a security that has significant assets and trading volume. And again, Sygnia, working together with Jane Street, is the partnership that creates these tight spreads in this deep market for you as investors. So let's look at the S&P 500 ETF. So if we first look at the S&P 500 as an index, it's a stock market index. It measures the performance of 500 of the largest stocks that are listed on exchanges in the United States. So this index is very popular for many reasons. Firstly, it dates back to 1926, so this index has been around for a very long time, but also because it's an index comprising of these 500 large stocks. It's very well accepted by many investors around the globe as the best representation of the US stock market. So back in 1926, when this index was first established, it started off only holding 90 stocks back then. And then in 1957 is when the index took its current form of comprising 500 of the largest and most liquid stocks in the United States. But what has changed over the years is, of course, what dominates the US stock market. So what are the 500 largest stocks? So back in the early 60s, it was predominantly, railway companies, industrials, a lot of utility type companies. Then as time went on, more financial stocks became bigger and more relevant in the index. And then in the early 2000s, of course, information technology, and that's still the case today. So if you look at what the index looks like today, it's predominantly healthcare stocks, information technology stocks, and then consumer stocks as well. So if you had to invest into the Itrix S&P 500 ETF, what would you get? So you would have 100% exposure to offshore equity. As I mentioned to you a little bit earlier on, the benefit of investing in this instrument is that you can invest, you can have exposure to this global index, but without having to worry about the limits on exchange control. So you will be invested in this ETF. This ETF will track this index. You will have exposure, as I'm showing you here on the right-hand side, predominantly to information technology stocks, healthcare, financials, and a lot of consumer stocks. The fee on this ETF is the lowest available in the market, and the total expense ratio was 20 bips as at the end of March. One of the biggest benefits of investing in ETFs and other pooled products is that you're able to gain exposure to household names, massive companies that are really driving these global markets. But not only that, a lot of these companies actually cost a lot to purchase as well. So the benefit of being invested in one of these instruments is that you can invest a smaller amount but still have exposure to these global companies. So Amazon is a good such example. Firstly, Amazon over the last number of years has done phenomenally well. They're involved in a number of different businesses, but predominantly it's your e-commerce, it's your cloud computing. They've got Amazon TV. So it really is a very, very successful firm. But to purchase one Amazon share will cost you about $2,500. Now, in Rand terms, that's a lot of money to purchase one Amazon stock. Microsoft, not quite as expensive as Amazon to purchase one share, but also costing you about $185 to purchase just one Microsoft share. Microsoft, another household name that we're all familiar with, and another stock that through time has done really, really well in the markets. And if we just have to look at the top 10, so the top 10, I mean, Apple, Amazon, Facebook, Alphabet, which is the holding company of Google, JP Morgan, a big financial services company, Visa that we're all familiar with, Berkshire Hathaway is Warren Buffett's conglomerate. So all of these companies are, great companies, very well known, not just in the US, but all over the globe. But I've included the dollar cost of each one of them. And it will cost you more than $5,000 if you had to just purchase one share of each. So again, making the point that you can invest a much smaller Rand amount in the S&P 500 ETF. You can have exposure to all of these brilliant global companies, and you wouldn't have to purchase each share, which would cost a small fortune, especially in Rand terms. So you'll gain exposure to the global market without having to also maintain that offshore, those offshore limits with the South African Reserve Bank. So the S&P 500 as an index has done phenomenally well since inception. What I'm showing you here is just what it has done over the last 20 years, and the performance really has been phenomenal. In Rand terms, there's also the exchange rate that plays a factor. So if you're investing in an economy outside of South Africa, so if we're investing in the US economy, our investments are then US dollar denominated. If the Rand weakens at the same time, then our Rand return. So when you take the US dollar investment and you convert it to a Rand return, if the Rand has weakened over the period, that further then adds positive Rand returns to your portfolio. So the S&P 500 ETF that I focused on today, we can see that over the last year has given us almost 27% in Rand terms. So what I'm showing you over here is the performance of all 10 of our ETFs that we have on offering, and you'll see that some of them have a longer track record than the others, and I've also listed the various inception dates. Another important thing is that these returns are annualized. So if we have to look at the MSCI Japan, for example, and we can see that over 3 years, it has returned 11.5%. The way to understand this is that had you been invested in this ETF over the last 3 years, you would have received 11.5% return per year for the last 3 years. So if this presentation has piqued your interest and now you are curious as to how can you invest in an ETF. So I've already mentioned this a little bit earlier on, but essentially the 2 easy ways are through a JSE stockbroker. So you can do so through your stockbroking account, or you can register on our Alchemy platform. So all of the details are available on our website. You can fill out an application form and we will give you access. And just in closing, Sygnia does have the longest performance track record in South Africa when it comes to passive management. We're very passionate about passive management. We're passionate about providing investors with great portfolios or instruments at very low fees. And we are the largest provider of index tracking ETFs listed on the JSE, and as you saw from our offering, we are the largest provider of international index tracking ETFs on the JSE as well. So that's all I have in terms of presentation for today. I will take a few questions, and the questions that I don't manage to answer in the session now, we will address with you directly in writing. I mentioned a little bit earlier on that we will be hosting another webinar next week, and our co-head of investments, Ian, will cover the very exciting Fourth Industrial Revolution Fund. I will look to take a few questions. We did receive a question from Dr. Pillay before the session, and his question was, how do you ensure that if you purchase an ETF of a retirement platform, that the price is not significantly higher from the NAV, so the net asset value? So we ensure that by working together with our market maker. So if the ETF, the actual instrument, is priced much higher than the NAV of the holdings inside the actual instrument, what Jane Street will do is they will then sell the ETF and buy the underlyings, and those trades will then bring the ETF's price closer to where the NAV is. So these mispricings, these deviations are actually very minor because of the working relationships between ourselves and Jane Street. So Jane Street makes sure that these arbitrage opportunities are not there in the markets. Okay, so there's a number of questions here. Some of them are around, can we get the slides? We can do so. Through ETFs, do I hold a portion of the underlying company share in the index? Yes, you do, and that is why if some of those companies also pay dividends, you'll be entitled to those dividends. How does the Standard Bank Oil ETN work? So an ETN, so ETFs are, as I mentioned, exchange-traded funds. ETNs are exchange-traded notes. So essentially in an ETN, and these are provided by the banks, what the banks will do is they'll issue these notes and they promise to pay you the return of the index. So if it's linked to the price of oil, then they in the background don't necessarily have to invest in that commodity that they're tracking, but they may use various other derivatives, and then they'll pay you the return of the instrument that they're tracking, which could be oil in this case. I'm sure there'll be a lot more information if we had to look at the Standard Bank's website there as well. Will Sygnia offer an MSCI emerging markets tracking ETF? So at the moment, you saw the offering. We currently don't have the emerging markets ETF, but if there's enough demand from our clients, we definitely could look into it. What is the difference between the Fourth Industrial Revolution ETF and the unit trust. So the difference will be in the structure of the actual instrument. So the ETF is something that you can trade on the stock exchange. There are many benefits to being able to trade an instrument on the stock exchange. For example, if you wanted to gain very quick exposure, so for institutional investors that might want to make tactical moves, and gain exposure to a certain sector in their portfolios, you can very quickly purchase an ETF and it will give you that exposure. So the tradability of being able to get in and out of the market is one of the benefits of an ETF, and a unit trust is just a different structure. What makes a good spread? So the spread, as I mentioned earlier, is the difference between the bid and the ask price. So the tighter the spread, the better it is for you as an investor, and it's indicative of a high trading volume. So the tighter the spread, the better. Okay, so there's quite a few requests or questions about the emerging markets ETFs, something that we'll definitely have to look at. What is the minimum rand amount I can start investing in an ETF? So all of these details are available on the application form on our website, but we have a minimum debit order of 500 Rand, and you can split that into two different ETFs. So the minimum amount into an ETF will be 250 Rand. But please do have a look at our website for more detail. There's a question around, do we hedge the currency when we invest offshore? No, we don't. So we don't hedge our currency risk if we're investing in these offshore markets. And as I mentioned a little bit earlier on, if the rand weakens, that can actually add a little bit extra rand return to your portfolios. How risky are ETNs compared to ETFs? So I mentioned a little bit earlier that these ETNs, which is the notes provided by banks, they're as risky as the issuer. So if you're investing with one of the big banks and you trust that they can pay their debts, the risk is really as risky as the issuer. If there's not much trust in that bank or institution, then there might be some risk that they won't pay you the return of the index that they're tracking. Okay, so quite a few more questions here, but what we'll do, some of them are quite long. What I think will be best is to take all of these questions, and for the interest of everybody, we can prepare a Q&A and we can have some detailed answers for all of you. So thank you very much for joining me this morning. As I mentioned at the beginning of the presentation, the idea for today was to have an introductory session around how ETFs work. If there is interest in a more in-depth technical discussion, we will gladly do a follow-up session. So thank you very much for your time. Thank you for your questions, and we will definitely address them after this meeting.